One tweet, 30 milliseconds. That's genuinely all it took for the algorithms to jump on it. JP Morgan actually built an index around it. They call it the Volfefe Index. And it tracks how his tweets move Treasury yields, live.
So today, we're pulling that apart, how the machines are trading this stuff before the headline even hits your phone.
Welcome to The Explainer. Today, we're exploring a seriously fascinating intersection where modern politics, social media, and algorithmic finance all crash together. Why does this actually matter to you? Well, because we're going to pull back the curtain on the invisible mechanics of how informal online statements are digested by the world's most sophisticated financial systems that literally hold everyday retirement accounts and steer the global economy. So I want you to ask yourself, how fast can 280 characters literally move billions of dollars? In our modern era, the answer is just milliseconds. Today, we're breaking down the hard, verifiable statistical impact of presidential social media activity on global financial markets. Specifically, we'll be looking at the data surrounding Donald Trump's use of Twitter during his presidency. And to be clear, we aren't looking at politics here. We are looking strictly at the math, the algorithms, and the market microstructure. All right, let's dive right in. Section 1, the social media market shock, turning 280 characters into macroeconomic events. To really get this, we have to recognize that a social media account belonging to a commander-in-chief is no longer just a communication tool, it's a literal macroeconomic shock event. Look at this data from a Bank of America Merrill Lynch analysis. They tracked the sheer volume of Donald Trump's tweets and found a direct, measurable link to the S&P 500's performance. On quiet days, the 10th percentile where there were fewer than 5 tweets, the market actually saw positive returns, averaging about 5 basis points. But on high-frequency days with over 35 tweets, the market yielded a statistically significant negative return of 9 basis points. Why does that happen? Because rapid-fire posting injects sudden policy uncertainty into the market. And if there's one thing markets absolutely despise, it's uncertainty. Moving on to Section 2. Quantifying the Volfefe Index, Wall Street's mathematical response. Wall Street wasn't just going to sit back and watch this happen, right? They had to quantify it. So enter the Volfefe Index. Now, you kind of have to appreciate the tasteful humor from the quants over at JP Morgan Chase here, naming a highly complex financial index after that infamous Volfefe tweet. But beneath the funny name is some incredibly serious math. Launched in September 2019, this index specifically tracked the volatility in U.S. Treasury bond yields caused by the president's tweets. To build their initial projections for this index, JP Morgan didn't just guess. Their machine learning software literally ingested and analyzed a staggering 14,000 tweets. They tracked all of it to figure out exactly which combinations of words were moving the needle on global interest rates. And what they found was a specific vocabulary of volatility. JP Morgan's models isolated exact trigger words like China, tariffs, Federal Reserve, and billion. When these specific words hit the Twitter API, boom, they acted as immediate triggers. We aren't talking about human traders reacting here. It was algorithmic and high-frequency trading systems instantly retooling their models the very second these words were published. Let's look at a real-world timeline to see this in action. The date is August 1st, 2019. At 1:26 p.m. Eastern Time, a tweet goes out announcing extended tariffs on Chinese imports. By 1:28 p.m., just 2 minutes later, algorithms have already parsed the text. Market liquidity instantly drops as automated market makers widen their spreads to protect themselves. And by 1:31 p.m., exactly 5 minutes after the tweet, the 10-year Treasury yield plummets from 1.94% down to 1.61%. That is lightning-fast, invisible financial gravity at work. Section 3. The statistical market impact. Academic evidence on stock behavior. So we've looked at massive macroeconomic indicators like Treasury yields. But what actually happens when a presidential tweet takes aim at one specific publicly traded company? Well, according to an event study analysis by researcher Justin Klejka, the answer is a daily abnormal return of 0.25% in the company's stock, directly matching the sentiment of the tweet. Tweet is positive, stock bumps up 0.25%. Negative, it drops 0.25%. But here's the thing, the price movement is only half the story. These targeted companies also saw a massive 19% spike in daily abnormal trading volume and volatility. And get this, While the initial price change might fade pretty quickly, that elevated volatility hung around for up to 4 days after the tweet, especially if it was fired off while the US markets were actively trading. Now, what's absolutely crucial here is how the market weighs this information. A fascinating study published in PLOS One found what's called an asymmetric market reaction. Basically, the market had a severe downside bias to criticism. When a company was attacked, its market value dropped sharply and significantly, but when a company was praised, the market was actually pretty indifferent. The positive impact was super muted. This cold, mathematical reality literally forced corporate PR departments everywhere to start actively managing social media as a genuine, quantifiable financial risk. Broadening back out to the whole market, studies in the Journal of Financial Research and the Journal of Economics and Finance noted that these posts spiked the VIX, which you might know as the stock market's fear gauge. These tweets increased what's known as jump tail risk. That's just a fancy academic way of describing the risk of abrupt, severe, and totally unexpected price shifts. Now, these spikes in uncertainty were sharp for sure, but they were also transitory, generally hitting their absolute peak around 2 hours after the tweet went out. Which brings us to Section 4, Algorithms and Automated Trading, the hidden machinery executing trades. So we need to ask, what is the hidden machinery actually executing these trades before a human can even reach for their mouse? It's driven by algorithmic trading, or algo trading. This is the use of computer programs to execute buy and sell orders automatically based on strict, predefined rules. These systems don't sleep, they don't get anxious, they don't second-guess themselves. They plug directly into data streams and broker APIs, completely removing human emotion from the equation. Let's break down exactly how a machine trades a tweet. Step 1. The algorithm ingests the live API data stream straight from the social platform. Step 2. It parses that raw text in microseconds, scanning for those specific trigger words like tariffs or China, and immediately assigns a sentiment score. Step 3. If its conditions are met, it executes predefined buy or sell rules. All of this, the whole shebang, happens in literal milliseconds. The machine digests the news and places the trade before a human reading the tweet has even finished sounding out the first word. It's wild. This reveals a pretty stark contrast in modern trading realities. On one side, you have human retail traders. Let's face it, we're slow to read, we're highly susceptible to fear and greed, and we have to physically swipe or click an app to make a trade. On the other side, high-frequency algorithms, millisecond execution, completely detached logic. This is exactly why automated market makers widen their spreads immediately during a social media shock. They pull their liquidity to protect themselves from sudden policy reversals that human traders haven't even begun to process yet. Finally, Section 5, the future of market volatility. Is social media the new financial terminal? When we bring all this data together, the evidence is just incredibly clear. Whether we're looking at a 19% volume spike in individual stocks that lasts for days, an immediate drop in Treasury yields mapped out by the Volfefe Index, or a sharp 2-hour spike in the VIX, the mathematical impact of this social media phenomenon is totally undeniable. Our market structure has literally evolved to treat social media feeds as top-tier, real-time fundamental data. Which leaves us with this final, really profound thought. Is the permanent tethering of global financial markets to social media feeds the new normal? As algorithms get faster and AI language models get even better at parsing human sentiment, this invisible machinery is only going to become more deeply ingrained in our economy. Thanks so much for joining me on this explainer. Keep questioning the data, and I'll see you next time.